Well, good afternoon all, and thank you for sitting in on this afternoon's session. Before we kick off, and I'm just going to ask my panelists just to introduce themselves, if you please.
Thank you very much, Stuart. I'm just looking at the screen and I realize that the company names are the other way around, but I didn't feel alien because I worked for Citi for nearly 23 years, so it is very familiar to see my name with the company name at Citi, but I'm the one who works for Deutsche Bank at the minute. So my name is Zeynep Öztürk. I joined Deutsche as the Chief Investment Officer nearly more than a year ago. And now I have an extended responsibility to look after all investments solutions as well as the lending and banking products for US and Europe.
So I'm not with Deutsche Bank, but I am with Citi. Tor Monson, so I'm responsible for alternative investments, sales and distributions in this region, so UK, Europe, and the Middle East. And based here in London, obviously. And at Citi Global Wealth, we do a lot of alternative and private market investments. So looking forward to sharing that.
Perfect, thank you. And the name is right for me. I am at Titanbay, which is a private markets platform that predominantly covers Europe and Singapore and Hong Kong. So I'll be able to give some insight into the topic today and how can wealth managers differentiate themselves in the private market offering that they're giving to the clients. I think we all know about questions via the app, and I can pick them up on the iPad. It's a relatively small group, so if you do want to just shout out, I'm sure that's fine. And we're happy to take questions as we go, but if you want to wait to the end, we can do that. And of course, there's the roving mic. So I guess today the discussion points around product, around the technology and the whole infrastructure that allows for scale in this marketplace, and everyone's talking about the democratization of private markets and introducing it to a new client segment. But I guess with so much to consider, what areas can you differentiate yourself within? And we'll discuss fund sourcing, fund structuring, marketing, compliance, the whole operational piece, the analytics and the data and all that good stuff. And we'll also discuss, more importantly, just the client appetite for alternative markets, but specifically, as the title of the session says, is just around the private markets piece. So I guess before we go into the title, the first question to pose to the panel is just around recent activity and how recent market conditions have impacted the alternative investment allocations within Deutsche Bank and Citi.
Should I go first?
Go on the floor.
Okay, so how has this current market environment, how has it affected alternative investments? So I think it's probably worth thinking about what are alternative investments, because there's sometimes can be a little bit of confusion, but we think about it as hedge funds and real estate, as well as private equity. What we saw in 2022 was a very, very challenging market environment, of course, and it was probably one of the few years where you had both equities and bonds being down significantly. So if you think about traditional investments, that is exactly that. That is like 60-40 portfolios, listed equities and bonds. So it's a very bad year. And many clients that we see and we meet with may have some allocation to alternative investments going into that, but usually being quite underweight. So we recommend, if you're a client of Citi Global Wealth and you have a medium risk kind of profile, we recommend that you have 27% allocation to alternatives. The reality is that a few clients have a lot more, but most clients have a lot less than 27%. So they went through 2022 suffering on their traditional investments. And that has really sort of boosted the conversation we have on alternative investments this year. And there are a few things we can do, right? We are not saying back away from 60/40 in traditional investment, not at all, but think about a more balanced approach. Hedge funds can deliver uncorrelated returns. So when your equity markets have going through a difficult time and bond markets and so on, there are certain hedge fund strategies that we like to focus on that has low beta, low correlation, and can be there to help stabilize your portfolio in these challenging markets. In terms of private markets, we saw quite clear cases of excessive valuations in 2021. And since then, valuations have been coming down. And because of the IPO market has been more or less shut for the last 2 years, the exit volumes have come down dramatically. So private equity funds have not been able to do M&A, to realize the investments in their fund to the same extent as one would have expected. And that creates both challenges and opportunities. And of course, you have interest rates, the cost of debt, the cost of leverage, which is also something we have to think carefully about when we look at private markets. But it also creates a tremendous amount of opportunities. We have increased or expected returns from private equity going forward from where we were a year ago. The reason for that is because all of this creates pockets of opportunities that we want to take advantage of. So our discussion with our clients and with our family offices is to really think about the alternative piece of their portfolio allocation, make sure that it's highly selective, but also make sure it is at a percentage and the weighting that is high enough to make a meaningful impact in the years going forward. Yeah.
Thank you, Thor. Zainab, would you like to add to that? Thank you.
Let me add on, from a maybe slightly different perspective, your question was also around the current market condition and how the current market condition impacts, in general, the investment behavior, and then specific private markets is the way I would like to answer the question. If we look back what has happened in 2022 post-COVID and then what we have now in 2023, a completely different market environment compared to the last decade of very low interest rates and really tight returns on most of the traditional public assets, turned into a place where we have significantly higher interest rates, higher inflation at the same time, elevated volatility, and kind of disruption in a way that the traditional public assets have been behaving, because you have a significant correlation between equities and bonds. You end up making money when market performs in a relatively positive news, but it doesn't live long, and then when one sell-off takes place in equities, you equally lose money with your bond portfolio. So in an environment like that, trying to make meaningful returns became a major headache for most of the investors. And one of the easiest low-hanging fruits, in a way, from an investment decision was to really stay in the most safest, easiest, and good return traditional fixed income kind of assets, because you now started to get a decent return or income for your, again, traditional fixed income allocations. And this kind of changed the perception into the private market investments. Because initially, when you have a very low interest rate market environment and a very low upside, where unless you get into further risky asset territory, private assets were a very strong alternative. And this was an important diversifier for a lot of the portfolio managers, also within our discretionary mandates. But now, in an environment where we are still strong believer of private assets, and the value of alternative investments within portfolio is not coming from pure return. It is also coming from access into diversified investments and ability to create a decorrelation in the portfolio. So this is the shift in the mindset. So the investment into private markets is not just driven by bigger pickup that you get from the public assets, but it is a significant decorrelation and additional value to create alpha in different areas of investment spectrum. So I think we see that trend emerging more and more with especially more sophisticated investors.
Yeah, and I guess from the platform's perspective at Titanbay, we've seen exactly this. There's been a flight to quality to the world's top tier offerings. We have wealth managers that are launching their private markets program, I guess, that Titanbay power, and they're building the building blocks into their future diversified portfolios and benefiting from some of the entry points just now. So the raises that we've done most recently and have been most successful have been in the secondaries market and benefiting from the prices within the secondaries market, and a fantastic place for the wealth managers that are just starting down this journey to start. But for the wealth managers that are with us and have been for the 4 years Titanbay's been around, the whole idea is just investing on a regular basis to create that diversified portfolio and what that diversified portfolio ultimately looks like in private markets. So I guess moving on, we can remain with the investment piece and the differentiation around how can wealth managers offer niche strategies over and above just some household funds. So maybe Thor, if you want to kick off again with that.
So the way we go about investing into private markets is we usually come up with a theme, something that we are interested in, we can see it's happening, it's a trend, and then we think about how can we invest into this. And then we sort of look around, and we have a team of more than 100 people at Citi Global Wealth, all focus on alternative investment sourcing. All of this is third party. We don't manage this in-house. So we go out and we find the best managers to do this for us. So for example, just before this session, I was in the other room listening to AI, right? So AI is undoubtedly a massive trend which is going to be with us for many years, probably for a generation. How do we take advantage of that on the private side? It's very difficult to know which are the most successful companies coming out of this. However, picks and shovels, I think that's probably a smart way to invest, because you need infrastructure to support this massive growth in data that being created and used and analyzed from AI. So data infrastructure, digitalization across the world globally. And then we go and think, okay, who are the people who can actually build this infrastructure, who have the large clients like a Microsoft, an Oracle, or Meta, or Google, that we can sort of invest alongside. So that's something, for example, which we think that's kind of an illustration of how we invest. There can be other things that are completely unique as well. And to Zainab's point, looking in private markets for investments that are less correlated to your traditional portfolio, right? An example of that could be acquiring minority stakes, for example, in a sports club in the US, which has very low volatility against macro environment, and you get your share of the media rights and revenues and so on. But it's very hard to access. But finding a way, partner with people who know that market really well, that can access it, that makes a lot of sense to us. And there could also be things in real estate. So we include real estate in our private market offerings. UK, for example, since we're here in London, with interest rates where they are now, a lot of people working from home at least a couple of days a week. There is a fair amount of stress in certain parts of the UK real estate, particularly in the commercial real estate market, which creates opportunities, and we want to take advantage of that too. For example, if people are spending more time outside of the city centers, there's demand for, big shop, warehouse type of shopping facilities and outside of city centers, but it's very hard to build these kind of things from scratch because how you get the planning permission and so on. So there are all these pockets of opportunities that we try to find. We look around the world because we are truly global, and this is how we help our clients. If you're a family office sitting in Europe, you may not have people on the ground in Asia, but we have. So if you look at Japan, there is no work from home policy, right? Culturally, and also, you go into the office Monday to Friday, maybe even Saturday, and you don't have the home office, right? You don't really have that if you work in Japan. So the office occupancy rate is close to 100%, which is very different from what we see in the rest of the world. At the same time, inflation, obviously much lower in Japan, interest rates and so on. So that's an interesting market. And this is how we try to navigate and find these things that are differentiated, it's niche. The last thing I want to mention about private markets in general is the size. It's grown tremendously over the last 20 years. And what that means is that if you run a successful company that you started, you don't have to do an IPO. You can rely on private capital to continue to grow your business for many, many years. The average tech company in the 90s IPO'd within 3 years of being started because there wasn't really any other choice. If you needed capital to grow your business, you had to do an IPO. Now you don't have to do that. The average is 13 years from starting a tech company to go and do an IPO. If you want to participate in that growth, you have to invest in private markets. By the time the company does an IPO, a lot of that is gone. So this is why we are telling our clients, be very selective, but you must have a meaningful allocation to these strategies if it's suitable to you, if you have the risk rating, of course, in these things.
Shall I answer for
Yeah.
the same question?
Please, thank you.
In terms of the investment strategy that we have within Deutsche Bank, it is coming from a more overall asset allocation and wealth advisory model. So what we are looking into is managing our clients' assets depending on the client's wealth segment, sophistication, understanding, etc., as most of the other wealth managers do. And within that, I think one of the things that we have been experiencing, especially again post-COVID economic environment that we are in, going back to some basics in the way that investors are willing to build their portfolios and trying to build resilient portfolios for the future generations, because priorities, concerns have significantly shifted in everyone's mind following the major pandemic and then consequences of various different geopolitical concerns that we've experienced around the world. When you bring them all together, what we have also now seen a move towards a macro trend. And I will try to connect that. It may not sound that relevant with a niche word and a macro trend, but actually it is very much, because what is going on around the world, how the macro fundamentals fall into its places, and what does that mean, what's happening in US economy into the particular businesses in China, for example, the semiconductor law or the tax regime that US has implemented. How do they then drill into certain businesses, sectors, regions, creates that theme that we all start to think about whether there is an upside and potential benefit to invest in that theme. So everything kind of starts from that. And then you see a lot of managers, especially in the private market, being much more agile to be able to adapt into those trends that are going to create that positive alpha in the next 5 to 10 years. And this is the place that we see a huge focus coming from very reputable, sizable managers spending a lot of time trying to identify those trends and then trying to create that niche that will give that positive alpha. So from our seats, actually, it is a great place to be, because so much investment coming through from not only big major managers, but also smaller size companies that are trying to get into the field of private market investments, managing it, and even making it more efficient, scalable through technology. So, and then we are on our side of the table, try to utilize them within our broader investment proposition.
Thank you. And I guess given from the platform perspective, in terms of we deal with really two sets of wealth management companies, and the ones with due diligence and research functions, not to the size necessarily of Citibank and the likes, and then we have ones that don't have the research in this space, and I guess they'll look upon us as outsourcing their private market CIO offering to the likes of Titanbay and being involved with our institutional due diligence process and with our strategic partners that we have there. And the ones that do have their own due diligence, they bring niche ideas to ourselves and simply ask us to structure feeders for them onto the platform, and then enjoy the benefits of what these platforms can bring in terms of operational efficiency, which I guess we're going to move on to. And the next question is around the potential hurdles of investing in the private markets asset class, and it's what operational efficiency and regulatory challenges do we encounter when offering private markets investments? And maybe, Thor, do you want to kick off with that one? Or?
Sure. Yeah, no, happy to. Listen, alternative investments are much more complex, obviously, than traditional investments. They are much more regulated. And we are here in the UK, in Europe, which is the most complex from a regulatory perspective. There are 27 different jurisdictions, I believe. There might be more, I don't know, in the EU. And the regulations are sort of shifting and changing, and the clarity that we have is a little bit lacking in exactly how we should go about bringing these ideas to all clients across this region. And Citi, we take the most conservative view. We always want to make sure that we do things that are absolutely right and appropriate. So the challenges is as such, our clients are also very often quite complex in how they are set up and structured, because we service ultra high net worth and family offices. So they might have a nationality, but they are resident somewhere else. They invest in an account which is in a different jurisdiction, and then they have maybe invest through a company rather than personal account, and then the marketing might take place in a completely different jurisdiction. So you have all these different layers of complexities, and the way we have to deal with this is we have built a largely in-house tool that has more than 50 checks before any of our clients can actually invest in any of these alternative investments. And we have to do that. So could we do these things a bit more efficient? I guess, yes, we keep sort of trying to evolve that system and that infrastructure. But it is still, it is quite time consuming compared to, trading in listed equities or mutual funds, obviously.
I'm dreading to answer this question because operational inefficiencies is everywhere, and alternatives or private market assets are at the top of the list in our at least agenda, because quite a lot of the processes are still new. If you think of the wider financial markets, a lot of the investment tools, assets, etc., have been there for much longer. They're much sizable, much impacting broader audiences. Therefore, whenever the prioritization of implementing certain automation comes in, it comes with the volume, etc. So the private market offerings are not only difficult for banks in terms of operational efficiencies or inefficiencies, they are also from clients' perspective, as you just rightly mentioned, as well as even the managers, because you can end up having very successful managers are leading with really strong themes and ability and capacity to come up with really good propositions, but the way then they communicate back with the counterparties, how they manage the capital calls, for example, or how they then report back into the performances, how you can feed that into your system. These are all complete non-STP, I have to be very honest. Therefore, you need to really find a way of making sure, depending from one strategy to another, whether it's a real estate or a private equity or even private credit, how do you integrate that into your platforms, into your systems? One advantage that we have is because of the way that we operate within Europe as a massive distributor of products across different wealth segments, our primary focus have been on more semi-illiquids rather than complete illiquids to start with, and then we started to benefit from the latest regulations, especially that come into bringing LTIFs into play and making sure that there is a better efficiency in the industry. So we try to really focus on the areas that we can tackle quicker, easier, and then make a much more efficient result for our clients. Everything at the top end of the spectrum where you really have much more manual process, especially within the private credit world, there are still quite a lot of inefficiencies in the process.
Thank you. And I guess where the platform space starts is day one is you list all these hurdles down and you create a platform that tries to eradicate 100% of those hurdles, and you get as near to it as possible. So if you look upon the regulatory side that Thor's saying, it's about ensuring you have the right client, the accredited client that can invest first and foremost, and then can invest in the jurisdiction that they're in, their entities in, and all this needs to be going on behind the scenes for then to go through to the next stage of the platform to be offered the investment opportunities that are aligned to that accredited investor and where they're invested. So we try and keep the regulatory side within the tramlines. Well, we do keep the regulatory side within the tramlines, ensuring that the appropriate investors investing in the appropriate vehicles. And then we covered off all things such as, digitalized subdocs, the capital calls, distributions, AML, KYC. And it's quite easy for me to sit here 4 years into the journey without the baggage of, a successful Citibank and Deutsche Bank, starting afresh and seeing how streamlined the system is and can be. And it's great to introduce new wealth managers into the offering and be able to give their clients access to an asset class that undoubtedly all clients do want access to, just to benefit from that the excess outperformance that asset class is bringing. So I listed out all the operational and regulatory inefficiencies, actually on 3 bits of paper. You don't want to see them, but there's a lot, and that's what the platform space is there to help out with. And even just the 50 checks that Thor mentions, it's all built in. That's great conversations to be having, and speaking to people that I was speaking to a UK wealth manager downstairs and said everybody here today is here because they accept change and want change to happen, and that's very much the emphasis of the platform space in the private markets world. Is we want to embrace this marketplace and we want clients to enjoy the outperformance from it, and that is ultimately where the platforms are coming into their own. So the next question I didn't write, but it does fall on me, but I will pass it to the panel, is what technical solutions or improvements can be implemented to streamline operations and reporting? And I'd maybe pass that to you, Thor, to kick off again, but you may pass it straight back to me.
It's tempting to do that. I can give it a go. Listen, there's, we probably not as efficient as we should be, that's for sure. There's a lot of different systems trying to communicate to each other through that entire life cycle of a investment. And keep in mind, these investments are, illiquid, they are very long duration. So everything from the first thing you can start soliciting to the transaction, to actually, statements and capital calls and distributions and so on. I think there's a lot of scope there to make that more seamless than it is today. We're working on it, but it has a lot of complexities, and especially if you're a global bank, you're in every single jurisdiction out there. There's a lot of things that needs to go into that process.
Yeah.
But yeah, we are looking at other things like, but yeah, maybe I'll hand it back to you actually. Yeah.
Zainab, anything I know?
I'm happy to listen.
So exactly to your point, Thor, and if you bring the platform space to life, it's slightly ironic. We're investing in some of the world's cutting edge companies within private equity, but we're doing it via paper and just huge administration teams. And I guess where we look at it from is we want to give access to the world's top tier investments. We want to get rid of the administration burden, and there's a lot going on behind the scenes to do that. It took 3 years to build out the platform in full, covering all the jurisdictions that we cover, and we are only mainly Europe, with some Hong Kong and Singapore. And then the crucial part is scale, because if what we're trying to do, we can't allow all client segments to be involved with this outperforming asset class. We're actually back at step one again, where it's to the benefit of the large institutions and the ultra high net worths, where we do believe, if you look just here in the UK, we're speaking about the final salary transfer markets and pensions, and that there's people in their late 40s and 50s that got millions of pounds in the pension pot, and they can't get access specifically to some of these really outperforming asset classes, which clearly they would like to get access to. So that's where we are, and to paint a little bit of where these platforms play within the B2B2C marketplace. You have two parts to it. You have the investment part, and this will be the same within the banks. You have the investment part, and then you have the technology part. That's the whole operation piece to it. So you have your fund sourcing, you have your structuring, crucially have your marketing, but it's your marketing, actually marketing the fund to the client, but marketing permissions to where the fund is allowed to be marketed to the client. And then we have compliance portals to ensure that the clients are kept within those tramlines, as I mentioned. The key part to me, and the part that I see developing, that's I think the most attractive part, is that online interactive tools, let's call them for want of a better phrase, that you can set your goals out, how much you want to invest, what your end portfolio wants to look like. You put your portfolio construction in, and then you can simulate what the portfolio looks like through its capital calls, and then distributions coming back, and then all the cash flow analysis. And the reason I like this is you see a client day one, and then 6 months later, you can reference back utilizing these tools, and it allows that client journey to be more visible in where they're ultimately trying to get to. And I always think the ultimate goal within private markets is achieving that portfolio where the capital calls are being fed by your distributions and more. You've got that self-fulfilled portfolio. It's just a lovely place to be. And that's just a fantastic tool for intergenerational financial planning, and clearly a fantastic tool for the ultra high net worth, but also the high net worth clients that you'll have within your wealth management firms. One part I would mention is data, and we're going to touch upon this a little bit later, but data and data integration, that's crucial, because the end client needs to see their reported portfolio as one. So the public markets, it's all there, and you don't want to turn the page and see the private market. So that's a key focus for the platform industry, is how our APIs are integrating into the wealth managers and banks that we're working with just so you can have that utopia moment where you press a button and you can report back to your clients as one. I'll move on to our second last, we've got 10 minutes to go here. Second last question is, how can technology empower the wealth manager, the advisor, and the investment teams to adapt to the changing market conditions of alternative asset classes?
Shall I maybe quickly take that? Because I want to also allow audience if they have any questions to us. I mean, in general, I'm sure everyone in the room will agree that technology empowers us to do a lot of things. This isn't an exception. So we will be able to not only see a holistic view of the portfolios, wealth managers, when they look into from a better technological platform through their apps or the way that we develop in our own systems or we outsource to our partners, being able to see the exposure of the investor through different investment buckets, underlying assets, etc., and then being able to give them an educated view on how they should diversify if they need, or if they're already in a good position, what can be the potential tail risks with the expected market volatility or conditions that are ahead of us due to some of the changes that I mentioned earlier. So in every part of our world, we have to accept the fact that we need technology. So I think it will be a kind of a simple answer, but immensely, basically.
Maybe this is somewhat related. We're actually looking into tokenizing.
We need another hour.
Yes. I don't know much about it, to be honest. But there is a team within Citi. We have a lot of different teams, but there is a team within Citi that looks at tokenizing various assets and the way we do things. Yeah. And private capitals or private equity stakes and so on, that is part of that. And whether we will succeed or when, I don't know. But I think all of these things should be, a huge benefit in the way we can access and report and operate on these things.
Absolutely, absolutely. We'll look at some questions. Has anybody got any questions from the floor?
Hi, Matt Chapman from Partners Group. I kind of have a question for each of you, hopefully, that will be a little bit difficult. Sorry, they're tricky ones. Thank you. Yeah, 3 tricky questions, a quick one. Yeah. Zeynep, you mentioned, you've got the European long-term investment funds, the retail vehicles, that you're distributing to your clients. In the UK, we've got the long-term asset fund, similar vehicle, going into people's pensions, like really democratizing access to private markets. How does that dilute the offering? Does it dilute your offering? Does it mean that it's more mass product? And how do you differentiate still? Tor, similar kind of question. A lot of local private banks are launching very competitive things to the ultra high net worth services. They're kind of trying to erode your solutions. What keeps you up at night with competitors? And on the competitor side, Stuart, your partnership with Mercer, as I see, is kind of competing with the international private bank model of providing investment research, but with the capability to deliver that for wealth managers. You're kind of disrupting your panel guests. Can you tell us a bit more about that solution, and is it a competition model? So over to you.
So we'll start with the order of questions. I don't think it dilutes in any shape or form, because what we are trying to achieve is to give access to all sorts of segments of wealth to different type of investments. And I think this is the beauty of the products that you just mentioned, because in our wealth model, we the difference of Deutsche Bank maybe compared to Citi, because I worked on both, is that we have the scale of retail, mass affluent, private banking, wealth management across different spectrums in every part of Europe, Asia and US. So we don't want to discriminate a certain group of clients and say we only offer private market assets, alternatives to the top end of our wealth. What we want to do is to utilize the new regulation that democratizes the access of retail into these new asset classes to be available for our investors as and when they like it to be. So we put them in our platform, we provide a nice asset allocation models for them, and then at the end, it's their decision whether to pursue or not. So we started to see a significant uptick from the retail investors on that.
Question two.
Yeah, question two. What keeps me up at night? So let's think about how we add value, Citi Global Wealth, to our clients. Our clients are some of the most sophisticated, experienced investors in the world. Ultra high net worth family offices. Someone told me there's 15,000 private equity funds out there. I don't know if that's true or not. I don't know how many, but there's a lot, right? We narrow that down to 15. So we go from 15,000 to 15. And that is the process where we add value. That's why we have 100 people sourcing and due diligence. And this is how we can come up where we can recommend things that are fully due diligence by us that has a very interesting approach. And I think what keeps me up at night is to make sure we have that. We have those products, right? We have those, we are able to access those, which we have continued to be. And that's so we stay relevant and current. I think that is the number one thing. Democratization is a great thing for the industry. As I mentioned, the private markets have grown tremendously, and more people need to be able to access. It needs to be part of a standard investment portfolio. So I think that would be my answer.
I just answer question three quickly. Is Titanbay has 7 parts to it. Part number 1 is the investment piece. I'm not going to go and see Thor and convince him that Titanbay's investment piece is for Citibank. It's a great conversation to have around the efficiencies that could potentially find synergies within from step 2 to 7. So it's around the relevant conversations that we're having with the relevant clients. And we deal with single family offices to multi-family offices to wealth managers to private banks. And there's a discussion to be had throughout all those ecosystems. The world's biggest banks do this very well and source the investments very well. I don't think there'll be a single client that I mentioned there that won't have a pain or an itch around efficiencies of administration, the burden of it, and the screams that come out of certain back offices. And that's the conversations that we have and try and help out there. We had a question over here, please.
Yeah, just be interested. My name's Antonio. I'm from a company called Investor Solutions based in Geneva in Switzerland. And we sort of also work similar to Titanbay. We work on democratizing private equity for family offices. But I'd just be interested in the panel's view on private credit, because I think at the moment it seems a pretty opportune time to look at it. I totally agree with you on secondaries. I think now, in terms of private equity, vintage years at the moment, these tend to be good years to invest. But something we've been looking at quite heavily is private debt at the moment. Obviously, the floating features, the wall of debt that's coming. Just be interested to get your views.
I can take that, because this is a very hot topic on our plate at the minute, mainly because of the fact that the, again, higher interest rate environment, kind of consolidation within the debt market, the liquidity issues that we had in the public market started to give some of the very wealthy investors and family offices the idea that actually there are immense opportunities in the private market that can give a much better return on risk that sometimes we lose sight, because we think that when you invest in bond indices, you assume that there's a huge liquidity and you take the full spectrum of the risk within the credit world, but effectively you have a huge risk on the lower end of the credit due to that weight within the index. So you might end up getting a much better return with a limited risk on a very senior exposure to a private credit issuer. So this is something that we acknowledge and we like, but at the same time, we know that it's not everyone's cup of tea and requires a significant amount of due diligence, education, etc. It is still early stages for the industry, and most probably by the time everyone is ready, the boat will be gone in terms of the actual value for investment. This is always the case, but there has to be a huge amount of investment when it comes into private wealth. But the accumulation of wealth on private hands is nearly 50%, and exposure to private credit is maybe 2% globally. So there is a huge opportunity that we can utilize.
And I just want to agree, private credit, absolutely, extremely interesting now. I wrote some notes before this, and it was a lot about private credit, not just private equity, but then I sort of run out of time. But I absolutely agree, yeah, very interesting.
Excellent, thank you. One last question, because we're at 0000, so.
Thank you for the panel members. I have a question on the platform Titanbay. So you mentioned that the model is a B2B2C where you serve wealth managers.
Yeah.
Why wouldn't Titanbay focus some effort towards directly servicing clients as opposed to going through intermediaries? As the term is democratization, it has to go all the way, but at least there's a hurdle there that would be interesting to know.
Absolutely, and that was a key consideration when the platform launched, and we focus on the middle B, the second B, which is the wealth manager, and how the platform can help in every way to allow the wealth manager to offer private markets to then client. To touch upon the end client proposition, it's a different model. When you start servicing high net worth individuals directly, the more successful you are, the more complex your model gets, and the more high net worth and ultra high net worth clients that come on board, you tend to find that they don't want to click a button, they want a relationship manager. And relationship managers in private market space don't come cheaply. There's not a load of them, but you'll need quite a few of them to give the appropriate level of service, let's say. And also the regulatory constraints that you have dealing with the end client completely different. Clearly, there's platforms out there that are doing it and being successful, and it's great. But our focus and main focus 100% is allowing the wealth manager to service seamlessly their end clients to give them access to this. And that's a scale model that we produced, and it is exactly that. We just need scale flow through the platforms, like all platforms, for Titanbay to be successful. I would just like to thank the panel, Thor and Zainab, superb, very, very good. And also thank all of you. It's been a pleasure to be up on stage, and I do think private markets is only going to become more visible in client portfolios, and I think as the years go by, we'll just be more relevant a topic and seeing more client money flow into this space. So